Hi everyone, Demir here from Westbound Wealth Management. In the next few minutes, we're busting 3 of the most dangerous and common myths in investing. The kind that feel right, sound smart, but quietly drain your returns. We'll break down why they persist, what the data shows, and how to protect yourself from making these mistakes. Look, we all love stories. Vikings wore horned helmets, medieval folks thinking the earth was flat, Marie Antoinette allegedly telling starving peasants to just eat cake. These are great tales, but none of them are quite true. It turns out investing has its own versions of these myths. So let's bust them, because your portfolio deserves facts, not folklore. Myth number 1. A weak economy means weak markets. It sounds quite logical, right? If the economy is in trouble, markets must be too. But investing is rarely that simple. The stock market isn't some kind of economic thermometer, it's more like a moody psychic. It cares less about what's happening now and more about what might happen next. So future earnings, investor sentiment, and expectations, those are the real drivers. Markets move on surprises, not on headlines. If everyone's expecting bad news, and the news is just less bad, the market can actually rally. It's like getting a C- on an exam you didn't study for. Somehow it feels like a win. And the data does back this up. Between 1958 and 1993, the correlation between GDP growth and market returns went from a strong 0.7 to 0. And globally, from 1988 to 2015, sometimes the two moved in opposite directions. I mean, look at China, a booming economy, massive growth, and yet not exactly lighting up the scoreboard for investors. So lesson 1, don't confuse a strong economy with strong market returns. They're distant cousins, but certainly not twins. Myth number 2. Past performance predicts future returns. We've all seen it. A star manager confidently showing their 1, 3, and 5-year returns like they're auditioning for Shark Tank. Impressive stuff. But here's the problem. Performance is not a personality trait. It doesn't stick around just because it showed up once. Yes, there are outliers like Warren Buffett, Peter Lynch, and others. But the average manager, let's just say you wouldn't bet your vacation fund on it. Over the last decade, fewer than 1 in 10 Canadian equity managers beat their benchmark. And those who did, when tracked over 2 consecutive 5-year periods, fewer than half stayed on top. That's worse than a coin flip. At least a coin doesn't charge you any management fees. So next time you're tempted to chase a hot hand, remember, in investing, luck can look a lot like skill until it doesn't. Let's dive into myth number 3. Investing near all-time highs is a bad idea. Yes, the fear of buying at the top. The market speaking, I'll wait for a dip. We hear that quite often, to be quite frank. Well, spoiler alert, waiting for a dip is like waiting for the perfect parking spot downtown. It might happen, but you'll miss a lot of great dinners trying to find it. Data shows that 1, 3, and 5-year returns after market highs are basically average. Peaks are normal. In fact, nearly a third of all monthly market closes are at or near all-time highs. Why? Because markets go up over time. I know it's not very shocking. The real mistake isn't buying at a high, it's not investing at all. Timing the market can feel smart, but time in the market is what actually builds wealth. Look, these myths persist because they're comforting. They feel intuitive, but intuition is not a strategy. What wins in the long run is evidence, not emotion. A steady hand, a patient mindset, and the courage to question what everyone quote-unquote knows. Because at the end of the day, mythology belongs in bedtime stories, not in your portfolio. Thank you for watching. If this helped clear the fog a bit, feel free to share it with someone who still thinks that markets are a mirror of the economy, or worse, that they can somehow outguess them. And as always, if you have any questions, you know where to find us. Thank you very much.